What's up everybody, Nate here, and the Federal Reserve is now considering lowering their benchmark interest rates and slowing the pace of their rate hikes. Lael Brainard, the vice chair of the Federal Reserve, just said that it might be appropriate to slow down Federal Reserve rate hikes in the future, although they have a long way to go because inflation is still pretty high. Now, if you haven't been keeping up, the Federal Reserve has been raising its benchmark interest rates all throughout 2022 in order to battle inflation. So far, they've raised their benchmark interest rates 4 straight times at 75 basis points. That brings the federal funds rate to an over 10-year high, and that has a huge impact on businesses and the stock market and everything else in our economy. But inflation has started to come down in the United States. Last week, we got the most recent consumer price index numbers, which basically takes a basket of goods and services in our economy and shows us, well, our prices going up or going down on average for all of these different goods and services. And over the last few months, prices have been starting to come down generally. Inflation on a year-over-year basis now sits at around 7.7%. That is down from the July high of 9.1%. So inflation has been starting to come down. So because of that, the Federal Reserve believes that they don't have to be as aggressive with their monetary policy at this point. So what exactly does that mean? What exactly does lowering interest rates mean in our economy, and is this going to help inflation? That brings me to what Lael Brainard has been saying right now. She actually believes that the Federal Reserve is in a decent enough spot to lower interest rates in our economy. And basically, when the Federal Reserve talks about raising and lowering their interest rates, they kind of look at 2 key data points. They want to look at unemployment and the jobs numbers, and they also want to look at price stability in our economy. We already talked about the first one. Inflation is coming down. It's been coming down for the last few months, and that's because businesses haven't really been spending that much because investors aren't investing as much, and all of that debt that businesses have been taking on is getting more expensive because they hold a lot of loans from the Federal Reserve, so they're not able to gather as much equity and as much capital to grow their business. And the other thing the Federal Reserve looks at is the jobs numbers. How are the jobs numbers in the United States? Where is unemployment at? And historically, when unemployment is at a historic low, then that typically means inflation is really high, and low unemployment has typically followed really low interest rates and a economic expansion for all different businesses. You got to remember, when businesses are booming, that usually means that there's low interest rates and investors have a ton of money to give because it's really easy to do so. They're able to give that money because they can take a risk on all of their loans. That means that businesses hire a lot of people, they hire a ton of staff, and sometimes they overhire people and typically pay them a lot more because you're in a time of really high inflation. So in the Federal Reserve's eyes, they don't want an extremely low unemployment rate because that means that many Americans have more money to spend, and with more Americans making more because of inflation, they can now buy more, and that kind of perpetuates your entire problem because businesses have to produce more, raising prices because costs also go up and are associated with that. So the Federal Reserve actually wants to raise the unemployment rate. They actually want more people to be unemployed in our economy because if people don't have jobs, then literally people won't have money to spend. So that automatically brings down inflation in your economy because now less people are buying things and businesses have more supply, and that's really the end goal here. They want supply to go up. So what exactly changed from the Federal Reserve that is now causing them to say, well, we can start dropping our interest rates sometime soon and slowing down the rate of our hikes? The main thing that has changed for the Federal Reserve is unemployment data and employment data. Job postings have been going down in the United States. They've been contracting, and now there's not as many jobs available per every single American that is looking for a job. In the Federal Reserve's eyes, that is a good thing, and it shows that businesses no longer can afford to hire a ton of new staff, meaning that demand is going down. They're not able to spend as much money, and your economy is getting a little bit smaller. Job postings are not at zero, but they were, 300 and 400,000 every single month, and now they're hovering around 200,000. So they're definitely going down, and that means your labor market is a lot weaker because in 2020 and in 2021, people were quitting their jobs because of inflation, because of work-life balance. I mean, we had something called the Great Resignation going on in our economy, but now it's pretty much ended because people can't just quit their jobs because there's not as many jobs out there. That gives a lot more power to the employer, and it means that the Great Resignation can't really continue. continue. So your jobs market isn't as strong. People have to kind of settle for jobs. And again, I don't know if that's necessarily a good thing, but it's a good thing in terms of inflation and for the Federal Reserve. And in addition, venture capital firms are not investing as much money as they were in 2021. Every single quarter, VC funding is down, and that shows that startups are not able to grow as quickly, meaning a lot less jobs, and we're probably going to see a lot of bankruptcies in the startup market and just in the larger stock market in general, because investors are not putting as much money into the stock market right now. They're not able to take on any debt because the federal funds rate sits at just over 4%. So now investors need to get a much bigger return on their money, and that's really difficult considering these businesses have higher costs. They're not gaining as much revenue because they have to pay employees a lot more, and it costs more to produce things. Plus, Americans aren't buying as much, so they're not going to gain as much revenue, which means their earnings reports are going to be smaller, and investors are not going to get a big return on their money, so they're just not investing money in 2022. Because of that, businesses are shrinking. The growth is a lot smaller, and a ton of your tech startups are laying off people. We've already had well over 100,000 layoffs in 2022 alone, and the fact of the matter is we're probably going to have more into 2023. This is simply because in 2021, businesses overhired. They hired so many people and they paid them a ton. Earlier this year, the Federal Reserve actually warned businesses that they need to freeze hiring because of the Great Resignation. People were looking for brand new jobs, but the only way to attract people was to offer them huge benefits and also a massive pay raise. That was not going to be sustainable, and now in 2022, we're seeing that firsthand. Company after company are laying off people, and that is trickling into unemployment. The unemployment rate has gone from 3.5% up to 3.7%, the biggest move in unemployment that we've had since April. So with all of that in mind, I know it was kind of a tangent, the Federal Reserve now believes they're in a place that the economy is shrinking. Inflation is coming down because fewer Americans have jobs. Businesses don't have as many costs, so eventually this gives supply in every single market, the housing market and also your goods market, time to recalibrate. That can meet up to where demand is going to be, and businesses no longer need to really start raising their prices aggressively anymore. They can keep them at what they're at right now because Americans are only buying so much. That will mean that we don't have overproduction and over inventory, and we don't have huge raises anymore, but it will mean that our entire economy gets back on track. Now, there is going to be some pain associated with that, as the Federal Reserve and Chairman of the Federal Reserve, Jerome Powell, has said. This means that there's going to be a lot of unemployment, and unemployment could go up to around 5% in 2023. And it's going to mean a lot of businesses just disappear from the stock market, and startups just cease to exist because they don't have the capital to survive. A lot of good ideas and innovation are going to go away in our economy for a little while. They just don't have the money in order to grow their business fast enough, or they have the money, but they're going to be really, really slow. And that kind of puts our entire economy's future on the sideline because now these businesses have a much slower growth rate over time. Obviously, your big players are going to continue to survive. They have the capital, they have the savings in order to do that, but a lot of your smaller firms and a lot of your cryptocurrency firms, like we already started to see, are just flat out going to disappear. What this basically does is reset our entire economy, but with the Federal Reserve saying they're going to lower their interest rates and actually slow down rate hikes, that means, for one, the stock market is going to love that. What that means is you're potentially seeing inflation coming down, and you're going to see the Federal Reserve eventually flip-flop and start pumping money back into the economy and creating economic conditions that allow businesses to grow, and the stock market loves that. Stocks are going to do just fine, and with the Federal Reserve lowering interest rates just in general, that means that inflation will probably go up in the future because people are going to have an easier time getting a mortgage or an auto loan or spending on credit cards. That means there's going to be a lot more spending, but this won't be a problem if the Federal Reserve does it at a pace that is controlled. If they just lower things to 0%, then that means we're going to have expansion to the highest level, and businesses will grow, they will hire a bunch of people, and nobody will even be thinking about a recession. But at the same time, it's also going to cause inflation to go way up, and we're just going to be facing all the same problems that we're facing in 2022. So it really just depends when the Federal Reserve starts lowering its benchmark interest rates again. If they start lowering them again with inflation being at around 2%, well, then that makes a lot of sense to do that. And if they slowly slowly bring them down from there. That will allow businesses to kind of recalibrate it, allow Americans to go out and recalibrate too, and spending will be at a semi-normal pace. However, if they raise their rates too aggressively and too fast, then that could cause a full-blown recession, a really bad recession. And that's the worry right now. The Fed might cause a recession that's so bad, unemployment goes up to 6, 7, and 8%. Inflation will quickly come back down, but the Federal Reserve doesn't want to see a huge recession like that. They want to see our entire economy and monetary system doing well. So if the Federal Reserve raises interest rates too aggressively, then they might actually flip-flop a little bit earlier than anticipated to help out our economy, but they can't do both. They can either lower demand or they can raise demand. If inflation kind of hits 5% and then they start lowering their rates, well, then that might mean inflation goes right back up to 8, 9, and 10%. But if they wait just a little bit longer, then that means this inflation problem might end up going away for a very, very long time. So like I said, for the Federal Reserve, it just depends on what the data looks like. It depends on what the price stability is of our economy, and it depends on what the labor market and what the jobs market looks like. If both of those things are kind of in an equilibrium and we don't have a massive teeter-totter effect going on, then you can expect the Federal Reserve to actually start lowering and slowing their rate hikes into 2023. But I don't have a crystal ball in front of me, so I can't tell you exactly when or if that is even going to happen. It really just depends on what those two factors are looking like and how the Federal Reserve wants to approach this inflation problem next year. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.